Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets and over 80 alternative strategy mutual funds, representing 80% of the AUM of the alternative strategy mutual fund market.
Hello, I'm Mike Kell, Senior Vice President, Program Management and Business Development here at AI Insight. And I'm joined by my counterpart, Laura Sexton, Senior Director, Program Management, to discuss our most recent private placement industry report of November 2020. Before I hand it over to Laura to get you to the details that you want, just quickly touching base. Through November 2020 is almost behind us. Certainly December is already going quickly, and I can only imagine the next few weeks are going to go just as quick. So certainly look forward to talking about how we closed out the year. But before then, I think November was another great month for us. Last year, November 20, absolutely a blowout month. So it was hard to imagine even touching that this year. And we did come up a little bit short, but year over year, we're still relatively flat. I mean, we're down just one entry, from a new coverage perspective. Last year, at the end of November, we were at 196. In this year, at the end of November, 195. Now, that does include publics. We just cover private placements on this, but just high level overall AI Insight, just to give you a general idea that we're on par with last year despite everything. So certainly hoping that we close it out with a strong December and from the number of new coverage so far this month, it certainly looks that way. So certainly excited to move on past 2020, but certainly excited to see how that coverage increases for the benefit of our subscribers through year end for sure. But with that, I'll hand it over to Laura, and Laura, give us a general idea of how we're looking from a coverage perspective through November.
Yeah, sure. So on the private placement side, activity slowed just a little in November from the prior months, but obviously, well above the kind of just post-COVID lows and the slowdown. So year over year, our coverage is down just a little on private placement, so about 4% down in terms of new funds that we started covering and about 7% down in target raise. This is especially apparent on the real estate side, so, which I think makes sense this year, but, some of the other smaller areas of our coverage have increased. Energy has definitely picked up, which we're going to talk about a little. Preferred private equity and debt offerings are way up, and a lot of these strategies are focused on opportunities created by the COVID-19 market dislocation. So we've seen a lot of that actually this year, and we'll talk a little bit about it. So of the 170 funds that we've added to our coverage in 2020, private placements that we've added in 2020, they were offered by 69 separate sponsors. And as of December 1st, we cover 192 private placements that are currently raising capital, and they have an aggregate target raise of $18.6 billion, and they've reported a raise so far. And of course, these are ones that are open; some are newer. So they've reported that they've raised about $10.2 billion, or 55% of their target. And real estate. Our coverage is pretty focused on real estate. This includes the 1031s, opportunity zones, non-1031 real estate LLCs and LPs. That's the largest component of our coverage and remains that way at about 68% of the funds and 59% of target raise. Private equity and debt, definitely kind of a smaller amount of our coverage in terms of the number of funds. It's only 9% of the total number of funds, but they're larger and represent about 29% of the aggregate target raise. So that's increased a little bit this year as new private equity and debt funds have been added this year. The average size of the funds that we cover that are currently raising capital is $97.1 million. Pretty big range from $1.9 million for kind of a smaller preferred offering to $3 billion for a sector-specific private equity and debt fund. So 17 private placements closed in November, so they closed their offerings, and about 83% of those met or exceeded their target raise. 157 funds have closed year to date. So pretty much every year we have kind of a sort of a turnover. We've added 170 new funds. We've had 157 funds close year to date. So it's, always kind of a dynamic market here, a lot of shifting and changing in the private placement market. So those funds that have closed this year have been on the market for an average of 330 days. and they've reported that they've raised 69% of their target on average. And of those funds, 85% of them met or exceeded their targets, and only 10% were able to raise less than half of their target, and 4 of the funds didn't report a raise. We did have 7 private placements suspend offerings and 1 terminated due to kind of the uncertainties related to COVID-19. And as of December 1st, anyways, there were 8 new private placements coming soon. So I wanted to talk just a little about that fundraising. So I said that, the 157 funds that closed year to date reported that they raised 69% of target. So, we're always having conversations with our subscribers on the, the broker-dealer and advisor and sponsor side. And I had a question from one of our sponsors yesterday that was interesting because they're a new sponsor to this space. And they were, it's been a little tougher this year. So they asked me, what does it look like for newer sponsors on our platform? And so I did a little digging on that and found that, it has been a little tougher. So, we usually about every year we see about, 10 to 15% of new sponsors. So all of the funds added on our platform, those are offered by, usually 85 to 90% are kind of existing sponsors or sponsors that have had a program in the past. This year, of the 170 new funds on the platform, 12% are offered by sponsors that are new to the space, so haven't had one on our platform before, really are kind of trying to get space. And so when you look at fundraising for funds that have been on the platform before, prior to this year, they have raised about 35% of their target. So obviously, again, those are all open programs. That 35% is not closed yet. They're still actively raising, but they've raised about 35% of their target, whereas those new managers on the platform, the 12% of the funds offered by new managers, have only been able to raise 15% of their target. So about 20% less than the sponsors who have had funds on our platform before. So it's been a bit of a tough year, and we are definitely seeing this in the research that we're doing outside of our world. So, Preqin has reported this several times that on the institutional side, there's been more concentration of capital into existing managers, and primarily because you just literally can't do due diligence this year. So it's been a lot harder for newer managers to break into the space because due diligence analysts and other analysts can't get out and meet people. And Mike, you and I have both been analysts in our past lives, and I know you know how important it is to see people and meet people. And there's just something about it. I mean, I think we're really learning that probably 99% of a job can get done virtually, but that 1% that you can only get by visiting someone and seeing them and really being there on site, getting a feel for the culture, it's so vital that I imagine for due diligence analysts it is a big struggle. So, I think it's just important to note that it has been a little bit harder for newer sponsors this year. Hopefully, as this vaccine comes out and things start to clear up, that kind of shifts back and is a little bit less of a struggle just because of the physical aspect. The other thing I might say too is, as for sponsors out there, I mean, as creative as you can get in terms of providing insight into culture, I think, would be really helpful. It's hard to do virtually, but, office tours, kind of meeting with different people, that's what you do as an analyst. You want to kind of see the different aspects of a firm and an office and a business. So, maybe some creativity there in terms of, trying to get analysts as much insight as possible. But I just thought I'd mention that, in terms of fundraising, that's been a trend. So, a couple of other trends that we've seen that I wanted to talk about. Again, we've seen a pretty big increase in the number of private equity and debt funds. I mean, in fact, you're 317% up in terms of target raise year over year, and definitely a lot of those have been focused on, COVID-19 market dislocation opportunities. But some areas are down. So one of the ones that we haven't seen as much of that we saw quite a bit over the last couple of years is opportunity zone funds. So those are down about 21% year over year in terms of the new funds. We've added 11 new funds this year. That's 21% less than we added last year. And in terms of target raise, they're smaller too. So, about 51% smaller in terms of aggregate target raise. So I had the opportunity to talk a little with Mike Fitzpatrick, who is one of the partners at Baker Tilly. They're one of our sponsors, and they have an Opportunity Zone fund on our platform. And I always, again, like to get kind of as direct insight as I can into these things. So talking with Mike yesterday, he was very insightful on, talking about a number of factors that really have kind of all come together at once. And in terms of Opportunity Zone funds, which is, they're not going to focus on the tax aspect of it, but it does have a tax component to it, obviously. So anytime you have an election like we had this year and a switch in administration, that this is weighing on the minds of investors. So, there's going to be some questioning of any sort of tax program. Same thing with 1031s. They're down 20%. We think probably will remain largely untouched, but they are too. But, that was kind of the first thing he said. And there's no doubt that has had an impact on investors and, sponsors offering new Opportunity Zone funds. He said the other couple of things, there's kind of a natural slow time of the Opportunity Zone annual cycle. So, the IRS did provide some timing relief due to COVID, extending the due date of tax returns. But, most of the gains, he said, larger capital gains come from pass-through entities. And many investors actually don't have visibility into those gains until they get K1 starting in late March. So, a lot of times they won't even know that they need to do this for a while. It's kind of a, natural cycle. And so, might be something that's kind of shifted, gains to next year potentially. The other thing that he said that they're seeing is, while you have, Opportunity Zone funds are really going to be focused on development, and opportunities out there, a lot of investors right now are focused and primarily interested in multifamily projects. And, those are a little hard to find in terms of, creating an Opportunity Zone kind of slice of the capital. It's a little bit more, you can certainly find a little bit more opportunity out there in office, retail, hospitality, and being formed kind of to capitalize on, some of the issues around these asset classes. But it's a little harder to find multifamily for a, kind of a slice of an Opportunity Zone fund. But that seems to be kind of the asset class that a lot of people are interested in. So he mentioned that too. And then the other thing he mentioned is just, the ability to obtain financing for Opportunity Zone funds or for development projects. Obviously, this year the lending markets are certainly more healthy than they were during the great financial crisis, but slowed down, pretty significantly in terms of lending for projects that aren't stabilized or fully developed. So, when you have a program that's focused a lot on development, it's going to be a lot harder to find financing for it. So that's, probably been part of the reason. So, just a little bit of insight into why maybe we've seen a bit of a slowdown in terms of Opportunity Zone funds. And so those are kind of the main trends that we're seeing. I mean, I think one thing the last thing I'd bring up is, that there's been several articles published lately about the kind of thought that there's going to be a significant amount of growth in private equity and private markets over the next 5 years. And there's been one by Preqin. Deloitte just published one forecasting that private equity AUM is forecast to increase 55% to $5.8 trillion by 2025. Preqin's was about a 60% growth, so it's, kind of mirrors that. And the thought is, and the rationale is that the global pandemic has definitely accelerated this trend of moving from public to private markets even more. It's already been in place, but now you have a situation where private equity firms were really able to help their portfolio companies move through a crisis by providing not only financial flexibility, a little more financial flexibility than the public markets, but also their expertise, their partnerships. They've been able to leverage their networks. And so this has been extremely valuable, and according to that article by Deloitte, especially for smaller firms who have taken kind of the brunt of the hit, that's a segment that's really struggled and needed the most support during the crisis, and having a kind of a private equity partner has been much more beneficial for smaller firms than if they had kind of public market equity that they needed to be concerned about. So, kind of just another trend that seems to be kind of accelerated by this downturn, similar to other trends. And so it's been an interesting year and a really interesting thing to watch. I think those are, some of the main trends that I wanted to cover, Mike. And certainly lots of interesting things going on. There's plenty more in the November private placement industry insights that you can take a look at, and hope everybody has a safe and healthy holiday here, and we'll be back at the beginning of 2021. So thanks, everyone.